For alternative investments, climate risk is rapidly migrating. It is leaving the sustainability function and moving directly to the core investment committee. Firms now have access to massive volumes of external climate intelligence, geospatial hazard models, localized emissions data, and specialized property certifications are all readily available. But looking at the standard setup for a private market FIR reveals a structural problem. On the left, we have rich environmental intelligence trapped in PDFs, spreadsheets, and isolated GIS applications. On the right, the strict financial matrix of a discounted cash flow model. A distinct gap separates them. Because these data sources exist entirely outside the core investment architecture, climate analysis happens on a parallel track. The risk is assessed alongside the valuation, rather than operating as an integrated component of it. If a climate assessment does not mathematically alter projected revenue, operating costs, capital expenditure, or terminal value, it is not an investment input. It is merely an observation. Bridging the gap requires translating climate science directly into financial valuation. To do this systematically, investment organizations must build a deliberate climate value architecture. This approach rejects the industry's historical reliance on static ESG dashboards and siloed sustainability repositories. Storing a building's LEED certification or GRASP score in an isolated database tells an asset manager their sustainability position. It fails completely to calculate what that position means for occupancy, rental demand, or future marketability. The architecture must calculate those outcomes. It requires a design capable of taking physical science, converting it into actionable commercial assumptions, and injecting them into the financial model repeatedly and traceably. This architecture ultimately provides the mechanism by which a firm turns raw climate intelligence into a repeatable, structural investment capability. Climate risk cannot jump straight from a weather model into a financial valuation. It must pass through a strict logical sequence. This flowchart tracks the required translation. First, physical hazards must translate to specific asset vulnerabilities. Next, those vulnerabilities trigger specific operational impacts. Those operational impacts then alter the financial inputs. Finally, those altered financial inputs generate the actual valuation outcome. We can run a wind turbine infrastructure asset through this exact sequence. The physical hazard is mapped as increasing wind speed volatility. The direct vulnerability for the turbine is that its strict operating thresholds are breached more frequently. The operational impact of those breached thresholds forces automatic safety shutdowns, which directly reduces total power generation. The financial impact of those shutdowns hits the ledger as lower revenue and accelerated capital expenditure for maintenance. The valuation outcome drops out of the model. Lower projected revenue directly reduces both the equity IRR and the asset's debt service capacity. The physical hazard itself does not dictate the value. The modeled economic consequence of that hazard is what drives the final decision. Institutionalizing this chain of translation across an entire portfolio requires a 4-layer technical stack. This stack starts with the foundational data ingestion layer. This bottom layer acts as the aggregator. It pulls in external geospatial hazard APIs, GRESB portfolio data, and green property certifications. Sitting directly above that is the ESG and hazard middleware. Here, raw external data is processed into investment-relevant logic. The middleware uses specialized engineering frameworks, like PCRAM, to determine exactly how a specific hazard will impact a specific asset. Once the logic is calculated, it passes up to the valuation engine. The engine takes those new, climate-adjusted operational assumptions and recalculates the traditional financial models, updating the DCF, NPV, IRR, and asset stranding projections. At the very top sits the consumption layer. This layer takes the finalized mathematical outputs and exposes them to the investment committee through portfolio dashboards and transaction tools. By structuring the data this way, the architecture creates separation of concerns without separating the meaning. Climate scientists can update hazard models at the base layer without breaking the financial formulas at the top. To ensure the investment committee can trust these outputs, this stack operates under 3 strict design principles. First is API-first integration. Analysts cannot manually copy values from PDF reports into spreadsheets. Spatial and certification data must flow automatically through governed pipelines to eliminate manual error. Second is version-controlled scenario analysis. Climate risk is inherently scenario-dependent. The system must test a base case against multiple physical and transition scenarios, strictly preserving the distinct assumptions tied to each version. Third is traceable grounding. Every material adjustment to the financial model must have a clear digital lineage tracing back to its specific hazard model or engineering assumption. If the investment committee challenges a sudden drop in a property's terminal value, traceable grounding allows the system to instantly prove exactly why it changed, which source drove the change, and which model transformed it. Operationalizing this stack establishes a dynamic, closed-loop system. When an external climate scenario updates, asset assumptions automatically update. These revised assumptions shift valuation metrics, altering capital allocation decisions. These investment decisions feed back into the bottom layer, expanding overarching portfolio risk data. This feedback loop is the mechanism a firm uses to institutionalize its understanding of climate risk at scale. Look at how this maps to the actual market. The granularity required here makes this architecture specifically critical for alternative assets. In public markets, standardized ESG datasets can be applied across thousands of generic securities at once. Private asset investors must underwrite a specific physical location, a distinct building structure, or a bespoke debt contract. The goal of this architecture is to price climate risk better than the broader market. If climate resilience is poorly represented in standard valuation models, competing investors will systematically overpay for exposed assets. An enterprise utilizing this architecture can accurately translate physical risk into cash flow impacts. They will identify highly resilient opportunities that conventional valuation approaches completely overlook. The enterprise architect designs the system where climate intelligence becomes asset intelligence, and asset intelligence dictates the investment decision. The result is a permanent, structural competitive advantage.